When headlines say that China has dumped $53 billion in U.S. treasuries, most people instinctively assume this is just another political headline, another chapter in the endless economic rivalry between great powers. But history teaches us that moves like this are rarely isolated and even more rarely harmless. To understand why this decision matters so much, you have to step back and look at the fragile architecture that holds global finance together, an architecture built on trust confidence, and the assumption that major players will not all rush for the exits at the same time. U.S. treasuries are not just government bonds, they are the backbone of the global financial system. Treated as the closest thing the modern world has to a risk-free asset used as collateral reserves and safe havens in moments of uncertainty. When a country like China, the second largest economy on Earth, starts reducing its exposure in a noticeable way, markets do not simply look at the number, they look at the signal. And signals in finance often matter more than raw data. This is where the parallel with Britain in 1931 becomes unsettling. At the beginning of the 20th century, Britain occupied a position similar to the United States today, issuing the world's dominant reserve currency, controlling global trade routes, and enjoying immense financial credibility. The pound sterling was trusted worldwide, British government debt was widely held, and London was the beating heart of global finance. But beneath that confidence, structural weaknesses were building quietly. Britain was struggling with declining competitiveness, rising debt burdens from World War I, and a rigid commitment to the gold standard that limited its ability to respond to economic stress. When confidence finally cracked, it did not do so slowly or politely. Capital fled, reserves evaporated, and Britain was forced to abandon the gold standard, an act that shattered its financial prestige and marked the end of its dominance. The key lesson from 1931 is not that one bond sale destroyed Britain, but that a series of decisions taken under pressure revealed vulnerabilities that investors could no longer ignore. Today, when analysts draw comparisons between China's treasury sales and Britain's collapse, they are not claiming history is repeating itself line by line, but they are warning that reserve currencies depend on confidence above all else. China's relationship with U.S. debt has always been complex. For decades, China accumulated treasuries as a byproduct of its export-driven growth model, recycling trade surpluses into dollar assets to stabilize its currency and maintain competitiveness. Holding treasuries also gave China a form of financial leverage, or at least the perception of it, a quiet reminder that America's debt was financed in part by foreign hands. But over time, that strategy has become less attractive. Rising geopolitical tensions, sanctions risks, domestic economic pressures, and the sheer scale of U.S. deficits have forced Beijing to reconsider how much exposure it wants to maintain. Selling $53 billion may sound small relative to the total treasury market, but again, markets do not think in absolutes, they think in trends. Is this a one-off adjustment or the continuation of a long-term retreat from dollar assets? That question alone is enough to trigger unease. Just as Britain learned in the early 20th century, being the issuer of the world's reserve currency is a privilege that comes with invisible constraints. It allows a nation to borrow cheaply and run persistent deficits, but only as long as the rest of the world believes that the system is stable and the issuer is disciplined. Once doubts emerge, even subtly, the reaction can be swift and unforgiving. Investors begin to demand higher yields, borrowing costs rise, and policymakers are forced into difficult trade-offs between growth, inflation, and financial stability. This is why China's move is being watched so closely. It is not about $53 billion. It is about whether the unwritten rules of the post-war financial order are starting to bend. And when those rules bend, history shows they can sometimes snap. The story of Britain in 1931 is not a dusty lesson confined to textbooks. It is a reminder that no financial empire, no matter how entrenched, is immune to the consequences of lost confidence. The uncomfortable question now is whether the United States is approaching a similar inflection point, or whether this is simply another manageable tremor in a system that has weathered many storms before. To go deeper into why this moment feels different, it is necessary to understand what actually caused Britain's collapse in 1931. Because the real danger did not come from a single dramatic decision, but from a slow erosion of credibility that investors sensed long before politicians were willing to admit it. After World War I, Britain emerged victorious but financially exhausted, burdened by war debts and an industrial base that was no longer as competitive as it had been in the 19th century. Despite these realities, British policymakers made a critical choice. They returned the pound to the gold standard at its pre-war value, essentially pretending that the economic damage of the war had never happened. This decision overvalued the pound, hurt exports, and forced the government to maintain high interest rates to defend its currency, even as unemployment soared and growth stagnated. Foreign investors began to question whether Britain could realistically sustain this position. As doubts grew, capital started to leave quietly at first, then more aggressively. Gold reserves drained, and the Bank of England was forced into increasingly desperate measures to defend the pound. When the final break came in 1931, Britain had no choice but to abandon the gold standard. triggering a sharp devaluation and a loss of global financial leadership that would never fully be recovered. What makes this story relevant today is not the gold standard itself, which no longer exists in the same form, but the underlying dynamic of confidence, rigidity, and denial. The United States, like Britain before it, enjoys extraordinary privileges as the issuer of the world's primary reserve currency. This status allows it to finance massive deficits, absorb global savings, and exert outsized influence over the international financial system. But those privileges also encourage complacency. When borrowing remains easy and demand for your debt appears endless, the pressure to impose discipline fades. Over time, imbalances grow quietly in the background. Today, U.S. debt levels are rising at a pace that would have been unthinkable in previous generations, while political polarization makes long-term fiscal reform increasingly difficult. At the same time, the dollar's dominance is being tested not by one challenger, but by a collection of forces: geopolitical fragmentation, regional trade blocs, digital currencies, and countries seeking to reduce their exposure to U.S. financial power. China's Treasury sales must be viewed within this broader context. Beijing is not acting out of impulse or emotion, but out of strategic recalculation. By reducing its holdings of U.S. debt, China lowers its vulnerability to sanctions, diversifies its reserves, and signals that it no longer sees dollar assets as the unquestioned anchor of its financial strategy. This does not mean China is trying to collapse the dollar. Such an outcome would harm its own economy. But it does mean that China is preparing for a world in which U.S. financial dominance is less absolute. And when one major player begins preparing for that possibility, others take notice. This is how financial shifts gain momentum, not through dramatic announcements, but through gradual changes in behavior that collectively reshape expectations. Investors, central banks, and governments watch each other closely, constantly adjusting their positions based on perceived risk. When enough actors begin hedging against the same scenario, the scenario itself becomes more likely. This reflexive nature of finance is what makes comparisons to 1931 so unsettling. Britain did not collapse because it was weak in an absolute sense, but because the gap between perception and reality became impossible to ignore. Once confidence broke, policy options narrowed rapidly, and decisions that once seemed manageable became existential. The United States is not Britain, and today's global system is far more complex, but the core lesson remains the same. Reserve currency status is not guaranteed by law or tradition. It is renewed every day by the collective belief that the system will hold. China's Treasury dump is one small crack in that belief, not a fatal blow, but history shows that cracks tend to spread when underlying stresses are left unresolved. Another layer that makes China RS decisions so significant is the way modern financial systems amplify moves that might otherwise seem modest. In a tightly interconnected global market, perception spreads faster than capital itself. When China reduces its treasury holdings, other countries do not simply look at the transaction in isolation. They ask, why now? And what China might know or anticipate that they do not. Central banks are inherently conservative institutions, but they are also deeply sensitive to shifts in risk. If the assumption that U.S. debt is endlessly absorbable begins to weaken, even slightly, diversification accelerates. This does not require panic or hostility, only prudence. A few percentage points shifted here, a few billion reallocated there, and over time, the structure of global reserves begins to change. This is precisely how Britain's dominance eroded, not through a dramatic overthrow, but through the gradual migration of trust elsewhere. In the early 20th century, capital began flowing increasingly toward the United States, not because America declared itself the new financial leader, but because investors concluded it was safer, more dynamic, and better positioned for the future. Today, there is no single clear replacement for the dollar, but that does not mean the dollar's dominance is unassailable. A fragmented alternative, where reserves are spread across multiple currencies and assets, can still weaken the central pillar. At the same time, China's domestic challenges add urgency to its reserve strategy. Slower growth, property market stress, demographic decline, and rising internal debt all limit Beijing's tolerance for external vulnerability. Holding massive quantities of U.S. treasuries exposes China to interest rate risk, currency risk, and political risk, all of which have become more pronounced in recent years. By trimming its holdings, China gains flexibility, even if it sacrifices some liquidity and yield. This is a trade-off that signals caution, not aggression. Yet caution itself can be destabilizing when practiced by the largest players. Markets are built on expectations of continuity. When those expectations shift, volatility follows. The comparison to 1931 also highlights another uncomfortable truth. Policymakers often underestimate how quickly conditions can deteriorate once confidence turns. Britain believed it had time, that temporary measures would restore stability, that markets would calm down. Instead, each intervention was interpreted as evidence of deeper trouble. Today, similar risks exist. If U.S. deficits continue expanding while political gridlock prevents credible long-term solutions, investors may begin to interpret every new borrowing spike as confirmation that discipline is unlikely to return. Rising interest costs then feed back into the deficit, creating a self-reinforcing cycle. This does not imply an imminent collapse, but it does imply narrowing margins for error. Reserve currency systems are resilient until they are not, and the transition from stability to stress is rarely linear. China's Treasury dump should therefore be seen less as a verdict on the present and more as a hedge against the future. It reflects a world in which major powers no longer assume that the financial order of the past 70 years will remain unchanged. And when assumptions change at the top, the effects eventually ripple outward to markets, governments, and ordinary people. The story unfolding now is not about who is right or wrong, but about how power, trust, and risk are being renegotiated in real time. History does not repeat itself exactly, but it often rhymes. The rhyme between 1931 and today is growing louder. One of the most overlooked aspects of Britain's fall in 1931 is how suddenly the consequences became visible to ordinary people. For years, the debate had seemed abstract, confined to bond markets, gold flows, and elite financial circles. Then, almost overnight, the impact spread outward, affecting employment, prices, and national confidence. This is why discussions about China's Treasury sales are not merely academic. If confidence in U.S. debt were to weaken meaningfully, the effects would not stay contained within Wall Street or central banks. Higher borrowing costs would ripple through mortgages, corporate loans, government spending, and ultimately household finances. This is the hidden power of the reserve currency system. Its benefits are widespread, but so are its risks. Britain discovered this painfully when the loss of sterling's prestige forced painful adjustments at home, reshaping its economy and global role for decades. In today's world, the United States faces a different but equally complex challenge. It must balance domestic political demands with its responsibilities as the anchor of the global financial system. Running large deficits may be politically expedient, but it relies on the continued willingness of foreign buyers to absorb ever-increasing amounts of U.S. debt. When a major holder like China steps back, even modestly, it raises an uncomfortable question: who fills the gap? Domestic investors can absorb some of it, and the Federal Reserve can intervene in times of stress, but these solutions carry trade-offs, from higher inflation risks to distorted markets. Britain's mistake was not simply economic, it was psychological. Leaders clung to symbols of past greatness, assuming that reputation alone could overcome structural change. The gold standard became a badge of honor rather than a tool, and abandoning it felt like national humiliation. The delay made the eventual break far more damaging. This is a cautionary tale for any dominant power. Adapting early is often less painful than defending the indefensible. China's actions suggest it believes adaptation is already underway. Rather than relying on a single reserve asset, Beijing is experimenting with diversification, regional trade arrangements, and alternative financial infrastructure. None of these moves will dethrone the dollar overnight, but they contribute to a slow rebalancing of influence. Meanwhile, global investors are watching how the United States responds. Will it treat these signals as noise or as early warnings? History suggests that reserve currency transitions are rarely announced in advance. They unfold gradually, punctuated by moments of crisis that retrospectively seem inevitable. The British pound did not lose its status in one dramatic event, but through a series of shocks that exposed its fragility. The dollar's future will likely follow a similar pattern, defined not by a single challenger, but by accumulating pressures. China's Treasury dump is one such pressure, small in isolation, but meaningful in context. It reminds us that trust is the true currency of global finance, and once questioned, it demands constant reassurance. The coming years will test whether the United States can provide that reassurance through credible policy, institutional stability, and a willingness to confront uncomfortable trade-offs. Britain failed that test in 1931, not because it lacked power, but because it misjudged the moment. The question now is whether history will judge today's leaders more kindly, or whether this moment will be remembered as an early warning that went unheeded. Another critical dimension often missed in surface-level discussions is how reserve currency stress reshapes global behavior long before any formal breakdown occurs. Countries do not wait for collapse to adjust. They adapt in anticipation. In the years leading up to Britain's exit from the gold standard, trade relationships quietly shifted, financial contracts were renegotiated, and capital increasingly sought jurisdictions perceived as more stable. By the time the crisis became official, much of the adjustment had already happened beneath the surface. The same dynamic is visible today. Nations are settling trade in local currencies, building bilateral swap lines, increasing gold reserves, and exploring payment systems that bypass traditional dollar-based channels. None of these actions alone threatens the dollar, but together they form a pattern of cautious disengagement. China's Treasury sales fit squarely into this pattern. They reflect not panic, but preparation. For global markets, preparation by major players is often more destabilizing than panic by smaller ones, because it signals a long-term shift rather than a temporary reaction. This is where the reflexive nature of finance becomes unavoidable. If enough participants believe that the future will be more fragmented, they begin behaving in ways that make fragmentation inevitable. The United States still benefits enormously from dollar dominance, but that dominance increasingly requires active maintenance rather than passive assumption. Credibility must be reinforced through policy coherence, fiscal responsibility, and institutional trust. Britain in the interwar period struggled precisely because it lacked these reinforcements. Political instability, labor unrest, and economic stagnation made it difficult to present a unified and credible front to the world. Today, political polarization and short-term policymaking pose similar risks. Investors do not expect perfection, but they do expect a plausible path forward. Without it, uncertainty fills the gap. China's move forces this uncertainty into sharper focus. It challenges the assumption that foreign demand for U.S. debt is automatic and permanent. It reminds markets that reserve currency status is ultimately a collective choice, renewed through confidence rather than coercion. As this choice becomes more contested, volatility is likely to increase. This does not mean disaster is imminent, but it does mean the era of effortless dominance may be fading. For ordinary viewers, the takeaway is not fear, but awareness. Financial systems shape everyday life in invisible ways, and shifts at the top eventually touch everyone. The story unfolding now is one of transition, not collapse. But transitions are rarely smooth. Britain's experience shows that denying reality only amplifies the pain when adjustment becomes unavoidable. Whether the United States can navigate this moment more successfully will depend on how seriously it takes the signals emerging today. China's Treasury dump is one such signal, quiet but consequential, a reminder that history is always watching, and that the future is shaped as much by preparation as by power. As this story continues to unfold, staying informed and understanding the deeper forces at work becomes essential. Keep watching to explore what comes next, how these shifts could affect global markets, and what they might mean for your financial future. And if you want deeper analysis like this, make sure to subscribe to the channel so you don't miss what's coming next. To fully grasp where this path could lead, it helps to understand that reserve currency decline is not a single event, but a process measured in credibility, adaptability, and response to stress. Britain did not wake up one morning as a fallen power. For years after 1931, it remained influential, wealthy, and respected, yet something fundamental had changed. The pound was no longer the unquestioned anchor of the global system, and Britain had to adjust its ambitions to match that reality. The same distinction is crucial today. Even if the dollar were to slowly lose ground, the United States would remain a major economic force, but its freedom of action would narrow. Borrowing would become more expensive, external shocks harder to absorb, and global influence more contested. This is why early signals matter. China's Treasury sales are not a prediction of collapse, but a reflection of hedging behavior in an uncertain world. And uncertainty itself has become the defining feature of the current era. Geopolitical tensions, technological disruption, climate risks, and demographic shifts all place new demands on financial systems designed for a more stable past. In such an environment, reliance on a single dominant currency feels increasingly risky to many countries. Diversification becomes rational, even inevitable. Britain faced a similar dilemma when its industrial base no longer aligned with its financial ambitions. Clinging to the old system delayed adaptation and intensified the eventual reckoning. The lesson is not that dominance must end, but that it must evolve. For the United States, this could mean difficult choices: fiscal restraint, political compromise, and a renewed emphasis on long-term credibility over short-term gain. These choices are never easy, especially in a polarized environment, but history suggests that postponing them only raises the cost. China's actions, viewed through this lens, are less about rivalry and more about realism. They signal a recognition that the world is moving toward a more multipolar financial order, one where power is shared, negotiated, and constantly tested. Whether this transition unfolds gradually or through crisis depends largely on how the current system responds to mounting pressure. Britain's experience shows that ignoring warning signs does not preserve stability. It undermines it. The coming years will reveal whether today us leaders can learn from that history or whether they will repeat its mistakes in a new form. For viewers trying to make sense of these shifts, the most important thing is to stay engaged and informed. These are not distant abstract forces. They shape interest rates, job markets, investment returns, and economic security. As this global story continues to develop, keep watching to understand how today's decisions could define tomorrow's world, and if you want clear, in-depth explanations of the forces shaping the global economy, be sure to subscribe to the channel and stay with us for what comes next. As this transition unfolds, it is important to recognize that moments like these are rarely understood clearly while they are happening. In 1931, Many observers believed Britain's abandonment of the gold standard was a temporary setback, not a turning point in global financial leadership. Only years later did it become obvious that the world had shifted permanently. Today, China's Treasury dump may be viewed by some as routine portfolio management, while others see it as an early chapter in a much larger realignment. Both interpretations can coexist, because structural change often hides inside ordinary decisions. What ultimately matters is accumulation. One adjustment can be dismissed, several can be debated, but many, over time, redefine the system. The United States still commands extraordinary trust, deep markets, and institutional strength, but trust is not static. It responds to behavior. Persistent deficits, political brinkmanship, and an expanding reliance on debt financing all test the patience of global investors, even loyal ones. Britain learned that credibility, once questioned, requires more than reassurance. It requires evidence of adaptation. That is the challenge facing today's system. China's move does not end dollar dominance, but it does puncture the illusion that dominance is effortless. It signals a world in which major players are no longer willing to assume that the old rules will always apply. For individuals, this matters because financial systems ultimately translate into lived experience. Currency shifts influence inflation, wages, savings, and opportunity. They shape which countries can respond aggressively to crises, and which must accept painful constraints. Understanding these dynamics is not about predicting collapse, but about recognizing risk and change early. History favors those who adapt rather than deny. Britain's decline was not inevitable, but its response made it irreversible. Whether the United States faces a similar fate depends on choices being made right now, often far from public view. This is why watching these signals closely matters. The story is still being written, and its outcome is not predetermined. What is clear is that moments like this, quiet on the surface but profound underneath, are the ones that reshape the future. Keep watching to stay ahead of these shifts to understand how global power is evolving and what it could mean for your money, your country, and the world ahead. And if you want to continue following deep, clear analysis of the forces shaping our future, don't forget to subscribe to the channel and stay with us for what comes next.